They finally did it. Not they like some cartoon villain, just the system doing what the system always does when volatility gets loud. It tightened the screws. The exchange raised margin requirements on silver futures. If you trade futures, you already know what that means. If you don't, here's the simple version. The exchange just increased the amount of cash you must post to hold the same position, same contract, same exposure. More money locked up. In most markets, that's a kill switch. Margins go up, leverage comes down. Forced sellers appear. The chart bleeds. Commentators call it healthy. Traders call it pain. Everybody calls it normal. But this time, something happened that should make you sit up straight. The market took the hit and didn't fold. Silver dipped on the headline because algorithms always do what algorithms do. They read the words, they sell the risk, they move first, they ask questions later. For a few hours, it looked like the usual script: margin shock, liquidation wave, bargain hunters trapped in a falling elevator. Then the elevator stopped. Not gradually, not politely. It stopped like a slammed brake. Buy orders absorbed the selling. The dip got purchased like it was a scheduled inventory restock, and instead of drifting back to normal, price snapped upward and held. Not a dead cat bounce, not a weak recovery. Strength. Here's why that matters. A margin increase is designed to punish leveraged longs. It raises the carrying cost of paper exposure. It forces the most fragile participants to choose between adding cash or cutting positions. So if price refuses to break after a margin hike, it suggests one of two things. Either the market is irrational and will collapse later, or the buying pressure is coming from participants who don't care about margin. Cash buyers, hedgers who can fund positions without blinking, industrial demand that can't pause production because an exchange the rules, and that's the first pillar of the story. Silver is no longer responding primarily to paper incentives. It's responding to something heavier, something that doesn't get margin called. Today, we're going to map the whole battlefield in 7 parts. Not hype, not slogans, mechanics. Because when a market ignores what used to break it, you're watching the system fail a stress test in real time. And the next question becomes unavoidable. If margin pressure didn't crack the rally, what would? To answer that, we have to go inside the machine that sets the headline price futures, then trace the chain all the way to the metal itself. Because silver isn't just a chart, silver is a delivery system. And delivery systems don't care about opinions. They care about inventory, timing, and trust. Let's talk about how that trust gets measured. Most people think futures exist to predict prices. That's not what futures are. Futures are a coordination tool. Producers, refiners, manufacturers, and financial players agreeing on a price for future delivery. It's a risk transfer machine. But there's a hidden truth that only matters when a market gets tight. Futures can set a price without being able to guarantee a product. That sounds insane, until you remember how most contracts end. The overwhelming majority of futures positions never result in physical delivery. They're opened, marked to market, and closed or rolled. The contract is treated like exposure, not like a claim ticket. That's perfectly fine until someone shows up who actually wants the product. And not once like a collector, once like a manufacturer with a production line, a schedule, and penalties for missing shipments. That's when a futures market stops being a casino and starts being a warehouse receipt market. So, let's define the 3 pressures that matter. Pressure number 1, margin and leverage margins. Rising forces leverage speculators to reduce risk. This is the exchange protecting the clearinghouse. It's not personal, it's plumbing. Pressure number 2, open interest and positioning. Open interest tells you how many contracts are alive. When price rises with rising open interest, it often means new money is entering. When price rises with falling open interest, it can mean shorts are covering or weak longs are being replaced by stronger hands. Pressure. 3. Delivery behavior delivers the moment the paper promise meets the physical obligation. Most of the time, it's routine. In a tight market, it becomes the only thing that matters. Now here's the key. Margin hikes can flush speculators, but they can't flush industrial need. A sole manufacturer doesn't stop buying silver because margin went up. A medical supplier does a pause because an exchange wants more cash posted. An electronic supply chain doesn't wait for a pullback if their inventory coverage is thin. They buy what they can when it's available and they hedge what they must. And that's why a margin hike failing to break price is a signal, not a headline. It suggests the marginal buyer is not a leveraged trend chaser. The marginal buyer is someone who funds positions like an operating expense, someone who sees the dip as procurement. But paper markets can still fake strength, right? Sometimes. So we need a better test, not price, not opinion structure. We need to look at where contracts are concentrating, how spreads are behaving, and what delivery months are doing. Because when stress hits a futures market, it leaves fingerprints, and the fingerprints show up in the place most people never look: the relationship between months, the curve, the roll, the spread. That's where the truth leaks out. If you want to understand a commodity squeeze, forget the headlines, forget the memes, forget the influencers, watch the warehouse categories. In exchange vault reporting, metal often gets separated into two broad buckets that confuse almost everyone. Eligible metal meets specifications and sits in approved vaults, but is not committed to satisfy futures delivery right now. Registered metal, specifically tagged and available to be delivered against futures contracts. Think of eligible as metal in the building. Registered is metal with a shipping label. Both are real, both exist, but only one is immediately deliverable through the exchange mechanism. And when a market gets tight, the registered pile becomes the choke point, because you can't deliver what isn't registered without someone voluntarily converting it, meaning an owner has to choose to make it available. Owners don't always do that, especially when they believe the metal will be more valuable tomorrow than it is today. So, here's the uncomfortable reality. A vault can look full on paper while the deliverable float is thin, and that's when weird things start happening. Physical premiums rise even if futures lips calm. Delivery times stretch. The market becomes obsessed with who has what, not what's the price. Now add one more layer: location. Silver supply isn't one pile on one island. It's a global network: refineries, vaults, shipping lanes, customs, insurance, assay processes, and time. Time is not a footnote. Time is the cost. If you're short silver and you need to deliver, you don't just need silver somewhere. You need exchange-grade silver, in the right form, in the right place, on the right timeline. And when timelines tighten, the market starts pricing urgency. That urgency shows up as near-month contracts trading rich relative to later months, spreads snapping, people paying to move closer to delivery, which brings us to a behavior that sounds backwards but makes perfect sense during a physical scramble. Instead of rolling forward like usual, some participants try to roll backward. They try to move their exposure from a later month to a sooner month. Because in a calm market, the future is reliable. In a stressed market, the future is a question mark. If you think that sounds dramatic, ask yourself one practical question. If you actually needed metal for production, would you rather own a promise for later or a claim for now? And if enough players start answering that question the same way, the delivery system gets crowded. Crowded systems don't fail all at once. They first show you subtle signs: atypical strength after bad policy changes, strange month-to-month pricing, open interest shifting to the front, delivery notices staying elevated, and a market that begins to treat certainty like a product you have to pay extra for. That's not a theory. That's how scarcity announces itself without using the word scarcity. Now let's go to the curve, the place where the market admits what it's afraid of. In a normal commodity market, the future is usually priced higher than the present. Why? Because carrying a physical commodity costs money: storage costs, insurance costs, financing costs, security costs, opportunity costs. That natural upward slope is called contango. Contango says, you want it later? Fine, pay the carrying cost. But when a market gets nervous about near-term availability, that slope can flatten or invert. When the near months start trading more expensive than the far months, that's called backwardation. Backwardation says, you want it now? Pay up. And it doesn't happen because traders suddenly get emotional. It happens because the market is pricing in a new risk, the risk of waiting. Waiting is cheap when supply is plentiful. Waiting is expensive when availability is uncertain. Now here's the part that matters most. Backwardation isn't just a chart curiosity. It is a behavioral signal. It reveals urgency. It reveals preference for immediacy over optionality. It reveals that some buyers value possession more than price. And that mindset, possession over price, is exactly what you'd expect when industrial users are trying to secure input material under stress. Because an industrial buyer doesn't think like a speculator. A speculator asks, can I make money if this goes up? An industrial buyer asks, can I keep the line running if this doesn't show up? That one difference changes everything. If your factory burns $5 million a day and you need silver to ship a product, paying an extra dollar per ounce isn't a debate. It's a cost of survival. So the curve becomes a battlefield between two worlds: paper participants who can wait because they only want exposure, and physical participants who cannot wait because they need material. When those physical participants show up aggressively, you see it in the spreads. Front month bids get heavy, rolls get expensive, later months stop commanding a premium, and people start making what looks like an irrational trade, paying more for earlier delivery even though it costs more to store. That trade becomes rational when the alternative is missing supply. Now layer this on top of the margin hike story. Margins punish leverage, but they do not punish necessity, so the exchange can raise margin, flush paper longs, and still fail to drop price if physical urgency is strong enough. In fact, margin-induced dips can become buying opportunities for the very participants who don't finance positions on margin. A forced seller hands a discount to a buyer who is already waiting. That's how squeezes get fed. Not by conspiracy, by structure. By a system designed to handle normal demand colliding with demand that has become time sensitive. And once the curve is distorted, it creates a feedback loop. Tightness makes buyers rush. Rushing tightens the front. Tight front lifts price. Higher price attracts momentum capital. Momentum capital increases volatility. Volatility triggers higher margins. Higher margins create forced sellers. Forced sellers create dips. Dips get bought by urgent buyers, and the loop repeats until something changes in supply, demand, or rules. So what changes? The answer depends on whether supply can respond. And that's where silver becomes uniquely dangerous, because silver is not just mined. Silver is often discovered by accident. Let's talk about the supply trap. People love the phrase, high prices cure high prices. Sometimes that's true. In many commodities, higher prices incentivize more production, more rigs, more drilling, more mining, more output, more supply, eventually. But silver has a structural problem that makes this textbook logic weaker than most people realize. A large portion of global silver supply is not produced by primary silver miners. It's produced as a byproduct of mining other metals. Lead, zinc, copper. That means silver supply is often controlled by the economics of a different commodity. So if industrial activity slows and base metal output gets cut, silver can fall as collateral damage even while silver demand is rising. That's the byproduct trap. Now add a second constraint, refining. Mining does not equal deliverable silver. The market needs refined product in specific forms and purities. That requires smelters, refiners, chemical processes, compliance, energy, labor, and time. Refining capacity is not a light switch. When the pipeline is full, it doesn't matter how badly the market wants more metal tomorrow. You can't refine next month's throughput today. So supply response becomes delayed, and delayed supply response is rocket fuel for volatility. But it doesn't stop there. Even if silver is mined and refined, it may not reach the public market in the way traders assume, because the supply chain can get pulled into private channels, long-term offtake agreements, direct procurement deals, strategic stockpiling. Deliver it to our factory, not to the exchange. When that happens, the metal exists, but it vanishes from visible pools. It never shows up as deliverable inventory. It never relieves the front-end stress. From the perspective of the exchange, it's as if the metal never arrived. This is how a market can experience a shortage sensation even without a literal global production collapse. The shortage is not no silver on Earth. The shortage is not enough silver available in the right form at the right time for the right channel. And when that happens, the pricing mechanism gets strained because the futures market is trying to price a commodity that's increasingly being allocated through relationships and contracts outside the exchange. That's when you begin to see two prices emerge, the headline price and the good luck getting it price. That gap isn't always visible in a chart, but it's visible in premiums, delivery times, and spread behavior. Now add geopolitics. Commodity supply lives inside jurisdictions. When a strategic metal rallies sharply, producing countries notice. Royalties, taxes, export rules permitting these can shift. Even rumors of policy change can tighten supply expectations because miners and refiners react by protecting their optionality. Optionality means I'd rather hold my product and see what happens next. That behavior reduces near-term availability, and near-term availability is what the front months care about. So if you're waiting for a clean supply response to cap price, you may be waiting longer than you think, because even if geology is generous, logistics are not. And even if logistics are solved, incentives can reroute flow. Which brings us to demand, the other half of the vise. Because silver demand isn't just investment anymore, it's embedded demand. It's industrial demand that scales with electrification. And that kind of demand doesn't negotiate the same way speculators do. Let's break down the two buyer classes that create the most explosive mix a commodity can have. In every commodity bull market, there's a moment when you can feel the buyer base change. At first, it's mostly financial. Funds, traders, allocators, people buying exposure. They're quick, price sensitive, and often leveraged. Then the market tightens and the second class of buyer gets louder, the buyer who isn't chasing profit. The buyer who isn't preventing failure. That buyer is industrial. And when industrial demand becomes urgent, it doesn't behave like an investor. It behaves like risk management. It pre-buys. It secures contracts. It increases inventory coverage. It pays premiums for reliability. It diversifies suppliers. It chooses expensive and certain over cheap and late. This is why silver can go from boring metal to strategic input in the span of a few quarters, because modern demand centers, electronics, solar, electrification, medical, defense, don't care that an exchange raised margins. They care that their next shipment arrives. So here's the explosive scenario. Industrial demand tightens the physical market quietly, month after month. Inventories get worked down. Spreads start whispering that something is different. Then investment demand notices. And investment demand is the accelerant. Investment demand is what turns tightness into headlines. It turns supply chain management into price discovery. Once investors begin competing with manufacturers for available units, bars, coins, deliverable grade metal, the market loses its cushion. And when the cushion is gone, every shock matters more. A refinery outage matters more. A shipping delay matters more. A policy rumor matters more. A margin change matters more. A margin change matters more. Because there's no slack. That's when price starts moving, not because people are optimistic, but because the system is repricing the cost of certainty. Now, a lot of people misunderstand what happens next. They think, if this is a squeeze, price just goes straight up. Real markets don't move like that. They move like this: sharp rallies, violent pullbacks, fake breakdowns, breathtaking reversals. Because the system is constantly trying to find the price that clears demand, and clearing demand in a strategic metal is hard because some demand doesn't disappear easily. Jewelry demand can slow, speculative demand can evaporate, but embedded industrial demand takes longer to adjust because redesigning products takes time, substituting materials takes time, building new mining and refining capacity takes time, so price often overshoots while the real world tries to adapt. That overshoot is where fortunes get made and where mistakes get punished. So if you're watching silver, the question isn't just how high can it go, the real question is, what does the end game look like? And how do you avoid getting shaken out or trapped during the most violent phase? When a market stops responding to traditional pressure, like margin hikes, the range of possible outcomes widens. That's not bullish or bearish by itself, it's unstable. So instead of predicting one outcome, map the realistic paths. Here are three. Path 1. The grinding breakout. This is the higher highs with savage dips path. Price continues trending up because physical demand keeps leaning on the market, but volatility increases because paper players keep piling in and getting flushed out. You'll see repeated margin increases, violent intraday swings, pullbacks that look like the end, followed by recoveries that make sellers regret it. In this path, the market stays tradable, but it's emotionally brutal. Path 2. The premium split. This is the two prices path. Futures price remains the headline, but physical premiums expand meaningfully, especially on smaller units and immediate delivery products. You'll hear, spot is X, but I can't buy it for X. Delivery times are weeks. Wholesale bars are available. Retail isn't. Certain formats disappear. In this path, the scarcity shows up in access, not just charts. Path 3. The policy and substitution, response. This is the real-world fights back path. High prices force behavior change. Manufacturers reduce silver loading per device, designers substitute where possible, recycling ramp, supply contracts get renegotiated, governments and regulators start paying attention to market stability. This path doesn't end the bull market instantly, but it can cap it, slow it, or reshape it. Now, one rule applies to all three paths. The most dangerous thing you could do in a volatile commodity market is confuse conviction with leverage. If you write about the long-term story but you're over-leveraged, the market can still remove you. Margins change. Volatility spikes. Liquidity disappears for a few minutes. Your broker doesn't care about your thesis. So here's the playbook built for reality, not slogans. Play number 1. Define your one. Are you a long-term holder seeking macro protection, a swing trader seeking volatility, a collector focused on physical possession? Those are different games with different rules. Don't mix them without a plan. Play number 2. If you hold physical, plan storage before you buy. Decide where it will be stored, how it will be insured, how it will be insured, how it will be verified, how it will be verified, how it will be liquidated if needed. In a tight market, convenience costs money and mistakes cost more. Play number 3. If you trade paper, respect margin as a 78-pin. Margin isn't just math, it's timing risk. If you trade futures or leverage products, you need a cash buffer position sizing that survives a volatility spike, a plan for margin increases, an exit rule that isn't emotional. Play number 4. Watch the right. Signal's price is the billboard. Structure is the engine light. If you want to understand stress, watch spreads between near and far months, open interest behavior during rallies and dips, delivery activity versus inventory categories, physical premiums, and delivery times. Those won't give you certainty, but they will tell you when the market is shifting from trade to allocation. And allocation markets behave differently. Finally, a word about targets. People love round numbers because round numbers feel like destiny. Markets don't care about destiny, markets care about clearing. The end game isn't the highest price. The end game is the price at which demand slows, substitution starts biting, recycling ramps, and supply channels stabilize. Until then, volatility is not a bug, it's the mechanism. So, if you just watch silver absorb a margin hike and stay strong, don't treat it as a meme moment. Treat it as a message. The marginal buyer may have changed, and when the marginal buyer is motivated by necessity instead of leverage, the old playbook stops working. That's when markets get loud, that's when they get dangerous, and that's when they get historic.